Hello, hi, good evening, everyone, and thank you so much for being here. My name is Ssuneet Kabra, and I look after the business development at Equitree. We're honestly super thrilled to see more than 400 registrations for our very first webinar, and more than 200 of you guys have joined today. Very happy to see everyone here, and thank you for being part of the Equitree family. We've decided to host this webinar because our family of investors and partners has been growing, and we felt that it was an important time to create a space where we can connect directly, share what's happening from inside the portfolio, and give you a sense of how we're looking at the markets currently. This is the start of what we will hope will become a regular way of interacting and engaging with you all. And with that, I'd like to hand it over to Ssuneet, our co-founder and CEO, to share some key updates from the team. Ssuneet, over to you.
Yeah, thank you, Sparsh. Thank you very much. I am Ssuneet Kabra. Happy to have you all for this first webinar of Equitree Capital. Before we go to the presentation, I want to touch base on few data points about Equitree. The journey started a few years back. We started with 5 crore check September 24. If I tell you a last 1 year data point, September 24, we were at 460 crore of AUM with 150 clients. September 25, now we are at 975 crore with 300 clients. The growth is really good. Recently, we have partnered with Avendus, Nuama, Lighthouse Client Associates, and we would be happy to go along with them for next 2000 crore journey. Our team is also growing. We are implementing a lot of tech in our system. We have recently launched our Gift City platform for our foreign investors. We have been grateful to all of you for supporting Equitree so far. Now we can go to the presentation. Pawan, next slide. Yeah. So this slide, which you can see, which market performance snapshot, you can see the last 1 year journey is quite a roller coaster journey for all the investors. You can see equities performance, which is showing a flat performance compared to the indexes. Indices are showing 5 to 7% negative performance, while equities are on a flat performance. That is because of our staggered deployment of investments, our valuation discipline. Next slide. This slide will show Equitree's performance. You can see Equitree PMS has compounded at 43.5% over 5 years, more than twice the benchmark, which has a 20.6% CAGR. Sustained outperformance across 2 year, 3 year, 5 year highlights the power of disciplined stock picking and compounding. You can see this data point. All the other indices, whether it is BSE 500, either it's Nifty small cap or Nifty 50, you can see the outperformance. It's smaller, 3.25 for 1 month, 1.91 for 3 months, 2.16 for 6 months. What we normally tell our investors that we are long-term investors. So you can see that 2 year, 3 year, 5 years outperformance is 16%, 20%, and 22% outperformance. Next slide. This slide will show you the broader market. Earlier slide, we saw the indices. Okay. Now this slide shows you the broader market performance. While we saw the indices outperformance, now we can see the broader market outperformance. First, you can see the large cap. More than 20% of the large cap got corrected, more than 20%. When you go to the mid cap, you can see 27% of the mid cap got corrected more than 20%. When you go to the small cap, you can see 38% of the small cap got corrected more than 20%. And now you can see the micro cap, which is the exact comparison of Equitree. More than 45% of the small cap got corrected 20%, right? This shows the Equitree's outperformance. And this is only because of the staggered deployment and the valuation discipline. Now I'll give you the slide to Pawan to take over the rest of the presentation.
Pawan, you're on mute. Yeah.
Am I audible now?
Yeah, we can hear you.
Thank you so much, Suneet. It's an absolute pleasure to connect with all of you guys. Thank you so much for being on this webinar. Let me address the elephant in the room. I mean, today, the biggest question that everybody has on the market is growth has not been coming about. Valuations seem to be on a higher side. And of course, then we have the whole Trump issue to address. So let's take one by one. This is a slide which shows in terms of how the growth has been over the last quarter as well as the last financial year. So if you look at this data, most of the segments have shown a tepid growth of about 8 to 9%. Whether it is BSE 500, Nifty, large caps have done about 10-12%. It's a micro cap which has delivered a 15% growth in the last first quarter. And last year was about 9%. If you look at the broader base of the data, nearly 50% of micro caps have delivered 15% year-on-year growth. And that's really commendable. People have been for the last few quarters waiting to see a double-digit growth coming about in the large caps, which has not really been coming about. And at that, valuations have been holding up high. One of the reasons for this tepid earnings growth has been weak consumption. There have been tariff headwinds. Domestic demand has been laggard and not been the best. So multiple other factors leading into this kind of a tepid growth. And this accentuates when you look at the valuations. So if you look at the valuations, they remain at an elevated level. Large caps, while the media reports would suggest that Nifty is trading at close to about 20 P multiple on a 1 year forward basis. That includes BFSI as well as PSUs, which typically trade at a lower P multiple. If you were to remove this thing, then large caps are trading at close to about 38.7 P multiple on a trailing 12-month basis, which doesn't sound to be very reasonable. And this is trading at a close to about 27% premium to the overall markets on the long-term basis.
You just have to click on your next slide, so it'll show up here.
Likewise, if you look at the mid cap, the small cap, and the micro cap, the mid cap is trading at close to about 51 times trailing 12 months P multiple, which is at a 46% premium. And this is a segment which generally is often referred to as a market being expensive. Similarly, if you look at small caps, small cap is trading at a trailing 12-month P multiple of 35.2, which is at 32% premium to its long-term averages. Our focus genre of companies, which is the micro cap, where typical average market cap is close to about 1500, they seem to be trading at a far more reasonable valuation of 24.8 on a trailing 12-month basis, which is at about 17% premium to its long-term average, which does not sound so obnoxious because the size of these companies have changed dramatically over the last 10 years. And that's where we find a lot of comfort to look at when we look for our investable opportunities. Which is why we say that aggregate numbers or statements can generally be misleading. More often than not, the mid cap and small cap is combined together. And that's what the market believes, that the valuations are extremely high or maybe not as reasonable. Based on this is how we are seeing the investor behavior shifting in 2025. A lot of people have gone to investing into gold, silver, and other commodities. Needless to say that this has done extremely well. So whether indices have been flattish or marginally negative, gold and silver have been on an absolute run over the last 1 year. A lot of people have also been fascinated with this whole idea of investing into pre-IPOs or unlisted markets or SMEs. SME exchange IPOs did dramatic run in 2024, and a lot of these have now got severe correction at that. Likewise, a lot of people have burned their hands investing into pre-IPO opportunities, where we've seen that recent IPOs have happened at almost about 25-30% discount to the valuation at which they were trading at before IPOs. Some people have been waiting, trying to time the market. A lot of investors, families, because of the confusion going on in the market, have chosen to be on the sidelines. So still, a lot of investors are sitting on cash, hoping to get some clarity around that thing. And of course, some large family offices have moved on to become global investors, where people have gone to investing into China, Europe, US as well. So that's how largely we are seeing the investor behavior moving in the last 1 year or so. Like Suneet mentioned, we are seeing increased traction in our genre of investing, which is between a private equity and public market investing, where we are substantially seeing a lot of money flowing in. From a base of 470 crores, we've moved about 975 crores over the last 1 year. Of course, the Trump tariffs, I think this is on everybody's agenda, and everybody's trying to understand that how this is shaping the world and impacting India per se. Well, we've tried to look at how the impact is on a very broad scale level. I think it's still in its infancy, and the world is waiting to see how this unfolds and how does it impact the global supply chain. Very broadly speaking, this is how we are seeing impact across multiple companies which have announced either a trade pact with US or at least where these kind of things have been announced. Needless to say, China and India seem to be the worst off, where China is expected to see almost about a 28% impact, where India is likely to see about 14% impact in what they're doing. This situation is definitely going to lead into realigning global supply chain arrangements. And in the interim, there is likely to be a demand supply disruption which can help. And eventually, this is the biggest question: who bears the cost? Whether it is the exporter, whether it is an Indian exporter or Chinese, or the importer at the American end, or eventually does it flow down to the consumers? This is still everybody's trying to find answers to this question. Depending on the segment to segment, based on what we have been talking about to businesses, we are hearing very different kind of connotations on this thing. Segments where US does not have the wherewithal to do their own stuff, there clearly the importer is bearing the cost. And these are B2B businesses, so it's not flowing down eventually to the end customer. Likewise, we have a business which is in the retail category where they are suppliers to Walmarts. But because this guy is one of the lowest cost producer, he still ends up being cheaper than his Chinese counterparts or with other Asian counterparts. So in that situation, it's neither the company nor the importer, but eventually the end customer who is bearing the cost. How this translates into demand, whether this leads into demand destruction, whether this leads into inflation in the US, these are things which probably will unfold over the next 12 to 18 months. All of this is definitely likely to result into a domino effect, depending on how this permutations and combinations play out. And that's what probably been the biggest tug of war between the president and the Fed chief, where the president wants the interest rates to be reduced, but the Fed chief believes that these kind of tariff scenarios will lead to increased inflation, and which kind of reduces his hands or probability for him to reduce the interest rates in a hurry. Now, all of this will have probably a second order, third order impact, depending on how this all plays out. There have been conversations where the US president hinted that he could reduce the tax impact on the consumers. If that were to happen, which probably will end up leaving more cash in the hands of the US consumer, that to some extent may help in bringing the inflationary scenarios. So we'll have to wait and watch in terms of how this plays out back in the US, and the second and third order impact probably will be felt only in 12 to 15 months from now. Global coordination needed. Needless to say, we have been seeing reactions and counter reactions of all of this tariff war going on. Suddenly, India getting close to China and China opening up their doors, the last one being for pharma industry. We'll have to, again, be keeping our eyes and ears very close to the ground, trying to understand that how this realigns and how does it impact Indian companies and our businesses in particular. In midst of all of these things, one thing which is coming out very clear to us from India's positioning perspective, or more particularly the engineering manufacturing perspective, is one, India did not have as much global market share. From America's perspective, it's not going to be easy enough for them to establish their own manufacturing base in a hurry. Even if they were to get started, it'll take at least about good 12 to 24 months time before they come up with any credible manufacturing base of their own. And in the interim, the options remain either to source from their Asian counterparts, which is China or India or Vietnam or Bangladesh, or to look up at Europe. Now, Europe has been going through its own issues, whether it is demographic issues or the increased cost of production post the Ukraine war. And all of this thing leads India in a very strategic position. Because if anybody in the world wants to reduce their exposure to China, then the only credible option remains is from sourcing from India. And we still continue to see that impact coming along with Indian exporters in most of our businesses, at least we track on. In line with this whole tariff issue, we've tried to do a deep dive in our own businesses. We currently own about 15 stocks. That's a deep dive and very concentrated investment that we do. Out of the 15 companies, only 3 businesses have a direct exposure to US. And of those 3 companies, average exposure is about 25% to the revenue. So if I were to look at our overall portfolio of 15 companies, we are looking at barely about 5% direct impact on the revenue because of this whole US tariff issues. And even within that, there are businesses which are not as much impacted. Like I mentioned to you, one of our consumer company, which is a supplier to Walmart, they are not facing any challenge. Walmart continues to source from them, and eventually the entire burden is being passed on to the US consumer. Another company which is there in the portfolio, which is into apparel. Now, 1 year back, these guys have moved to Sri Lanka. Not that the guy had any clue in terms of the tariff issues coming along, but as part of its normal geographical expansion and more from a risk diversification perspective, these guys chose to move to Sri Lanka. And that thing is coming in handy today. Of course, it's not easy that you can just press a button and shift the entire production to Sri Lanka overnight. But our sense is that over a period of maybe 1 quarter, he should be able to move the entire exposure to Sri Lanka. And if that happens, then the blip in the business remains only from 1 quarter perspective. Of course, everybody is hoping that this 50% tariff regime may not work out very long, because 25% is anyways as a penal tariff because of the Russian oil import. And the hope is that this should settle probably more in favor of India than to continue at a 50% higher tariffs. So even if in that situation, as the tariffs normalizes, which one is hoping for to get close to about November or December, we should see normalization coming about into these companies over the next 1 or 2 quarters. Needless to say that yes, we will indeed see some blip for the next 1 or 2 quarters in some of these businesses. But we don't expect this to remain from a long-term perspective or really getting deep onto our businesses. And that's the summary. 80% of the portfolio is insulated from the tariff because we're completely, rather largely focused on the domestic businesses. As I mentioned, some of these businesses are working around trying to pivot away where they reduce this whole US tariff impact and ample opportunity from the domestic demand. And newer geographies are opening up. I mean, some of our companies, they are now looking at Africa, which was not even a market for them until about a year back. So there is this diversification that the promoters are trying to work around and see how best they can maneuver through this kind of challenges. While we spoke about growth in terms of what the market has done, where we saw average growth of about 9 to 10%, our portfolio has seen dramatic difference in terms of the growth itself. 75% of our portfolio has reported a median growth of 19% in the first quarter. In fact, if I look at my last year's number, we saw a growth of almost about 20% at a portfolio level. We had about 4 companies which saw some bit of headwinds in Q1, And that led to a slightly truncated growth number at 11% for the overall portfolio. Of those four companies, three of them experienced a one-off in the first quarter. And as we remain engaged with these businesses and talk to them, they continue to maintain their full year guidance. And backed on this thing, we still continue to maintain our full year guidance at a 25% growth to come about at a portfolio level. And at this, again, looking at the valuation aspect, while we saw the valuations of microcaps to be close to about 24 times, our portfolio is trading at about 16 times, median multiple of 16 times on FY26 numbers, which translates into a PG of just about 0.6. And this puts us in a very, very sweet spot where our businesses are delivering growth and the valuations are very, very reasonable. In fact, most of these companies are trading close to their 10-year average multiples. And that gives us huge amount of comfort to buy deep into these businesses. From a business visibility perspective, as we remain engaged with most of our businesses, we believe that some of these businesses are very sweetly positioned to see a consistent compounding of 20 to 25% over the next 3 to 4 years. And that being the case, and the valuations being closer to its 10-year averages, gives us huge amount of comfort to buy deep into the portfolio. This is how our portfolio diversification looks like. So as most of you would be aware that we are largely focused on infrastructure, manufacturing, engineering businesses. And these are the businesses where we have been seeing this growth coming about. If you look at infrastructure, that combines of railways, that combines of companies which are suppliers into the road construction, as well as in other parts of infrastructure. Agriculture remains a very large position for us, and this is basically largely the agri equipment company that we have invested into. It comprises almost about 11% of the total portfolio. Apparel, including the one that I spoke to you about, we have two companies broadly which are in the apparel segment, collective exposure of about 10%. One of them is completely focused on the domestic markets, and the other largely being export oriented. Engineering products comprise of 10% of our portfolio. These are again companies which are both looking at the domestic market as well as exports. And like I mentioned to you, these companies are today getting into the global supply chain as the world is looking at India as a credible supply option. Chemicals and materials comprise 10% of our business. These are not high-end specialty chemicals, but rather more commodity chemicals. But these are businesses which generate extremely high cash flows. Auto ancillaries, again, the GST boost has given a new lease of life to the whole auto ancillary segment. Even without that, some of our companies have been seeing consistent compounding for the last good 6-7 years. So this business that we have been holding for the last good 7 years has been consistently compounding at 22% and is sitting on an order book almost about 2.5 times its revenues, which is to be executed over the next 3 to 5 years time. And that gives us huge amount of comfort and confidence in terms of holding on to these businesses and buying deep into these businesses. Consumer durable, with again the GST boost that is coming about, both the domestic consumption as well as the offshore opportunity remains very, very credible for this kind of business. We're very excited about this business, and hopefully we should be seeing revenues actually becoming 3x over the next 5 years time into this business. Lastly, while we are holding about 16% in cash as of today, and I would like to, despite the favorable fundamental matrices, one would probably have a question in terms of why we are holding this kind of a cash. There are two parts to the cash that we are holding today. One is because of the continuous incremental inflow that we are getting, and that has been keeping our cash levels slightly elevated. The other part of the cash level is from our own staggered investing discipline that we follow, which makes us build a portfolio over a period of 3 to 6 months time. So despite the lucrative fundamental matrices that we have, we're still not going berserk or getting over exuberant in building up the portfolio. We understand that the markets probably can continue to remain volatile in the short run, and which is why the staggered investing always helps in building up the portfolio reasonably. In fact, as Ssuneet mentioned early on, that's been one of the cornerstone for us to maintain that stagnancy over the last 1 year, where the market has seen a deep correction of more than 20%. So that's how the portfolio construct is today. To be diversified meaningfully across 10 sectors, which is largely aligned to India's long-term growth themes. This is how we look at our investing. So when we are looking at buying into businesses and buying deep into them, we typically taking anywhere between 3 to 5% stakes into these companies and looking at very long-term compounding. These are some of the factors that we look at. Large addressable market opportunity, consistent growth. So ideally, the business itself should deliver a 25% growth to us. And if the business delivers that kind of a compounding, then we don't have to play the market to generate our returns. And that's extremely important to us. In fact, what you saw over the last 5 years track record and performance, large part of that performance has actually come because of the underlying growth of the businesses. Of course, we did see some bit of re-rating in the stocks, and the stocks which ran ahead of our comfort zone over the last 2 years, we've completely exited those stocks. So that's an auto correction that we build into our portfolio. Most of our businesses are cash generating, and this is something that we very deeply and very keenly focus on. Most of our balance sheets are very, very strong. Debt equity at a portfolio level remains just at 0.2, where most of our companies actually remain debt free. Promoters' skin in the game, that's again extremely important element for us. We generally don't buy into businesses where the promoter is either consistently diluting or he's been selling his own stake in the business. Reasonable valuations, like what we just saw, most of the companies are trading close to their 10-year averages. And that's where we believe that where in this kind of a market where confusion prevails and the stocks are seeing stagnation or correction at that, for us, this is like, having a mega sale going on where businesses are delivering the growth, but the stock prices are probably behaving as what they were 2 years back. So you can't have a better situation than this to actually buy into these kind of companies. So whether it is Shakti, HBL, SP Apparels, Pushkar, or Talbros, those being our top 5 holdings, each one of them are trading close to their 10-year averages. And that's what gives us that huge comfort into buying into these businesses. You would have probably observed that SP Apparel, we've kept this thing blank in terms of consistent growth. And that's primarily because of this multiple headwinds which are going on with the business. We believe that this is a business which is multi-decadal as this business is moving away from China to Vietnam, Indonesia, and now to India. And given the way this company is positioning itself with respect to their capacities, geographical diversification, we believe that from here on, this has the potential to at least deliver a 20-25% compounding over the next few years. I think most of you would have either invested into other PMSs or mutual funds for sure. And we thought it will be a good recap in terms of how we are different from most other small cap PMSs and most other small cap PM mutual funds as well. So to begin with, the big difference lies in our private equity approach, where we like to get into companies reasonably ahead of time, where we understand that we are taking execution risks and the fact that these companies may take time to scale up. But that allows us to get into a far more reasonable valuation as what you would have seen at the portfolio valuation, what we spoke about, and enjoy the entire growth journey and eventually, hopefully, look to capture the value discovery premium. And that's what adds to the significant alpha returns that we saw. So when we are seeing that we have been consistently doing 2x of what the market benchmarks have been, that's coming primarily because of this underlying high growth of the businesses and trying to capture the whole value discovery premium. That P approach for buying deep into these businesses once we have the conviction and allowing the business to compound from a long-term perspective rather than focusing on short-term 30, 40 or 50% returns. That really doesn't excite us. What excites us is the fact that can we buy into a business which can compound at 25% and hold the business for 10 years, such that it becomes a 10x in the portfolio. That's the thought process and approach with which we look to invest into. Second and more important difference from a listed market perspective is that most fund managers end up looking at market price as the barometer for decision making. Typically, a stock goes up 2x, 3x, 5x, and probably you would look at booking profits and exiting. Very rarely you will come across fund managers who are buying deep into a business which has become a 10x. In our case, there have been a couple of our companies which have become more than 30, 40x, and we're not just comfortable holding them, but buying deep into the businesses even today, as the growth journey remains very visible and the valuations also remain broadly within our framework. And that differentiates us from the broader listed market fund managers who are largely driven by the stock price. You see a stock maybe 25, 30% down, and probably most fund managers would want to book losses and churn the portfolio and try and move into hopefully better pastures. For us, when we are holding a business from a 5 to 7 year perspective, it's not out of context for us to see a business seeing a lean patch for maybe 2 quarters or maybe 1 year or 2 years at that. We just spoke about SP Apparel for an example, which has not been reporting growth. But despite that, the structure of the revenue is changing and the balance sheet is only getting better year by year. And that gives us huge amount of comfort to buy deep into this business. When even today, they probably market is grappling with this whole tariff issue. From our perspective, we are seeing this as an opportunity to bulk up on the holding. Another important aspect that I want to highlight over here is when you are looking to buy a 3 to 5% stake into these businesses, which don't need primary capital, it remains very difficult for us to build up the portfolio. And it's only in times like these where the weaker hands are selling, which allows us to buy. I very often hear investors, fund managers alike, who are looking to churn the portfolio in the last 1 year, move out of loss-making companies, get into hopefully opportunities which they feel that can deliver returns. And that's where we start differing in our thought process and approach. Our smaller AUM provides huge amount of agility to us because whether it is the small cap PMSs or the other small cap mutual funds, given their large size, typically, if you look at mutual funds, they would be managing anywhere from 10,000 crores to going up to 40, 45,000 crores. At that size and scale, they can't meaningfully deploy into a 2,000 crore market cap opportunity. Even most small cap PMSs, they generally look to buy into businesses which are closer to 3,000 or 3,500 crore market cap. It takes a lot of effort in terms of getting deep into a business which is about 2,000 crore market cap and spend a lot of time at the shop floor level in terms of understanding the business and having this kind of long-term approach to investing. And that again differentiates us substantially from most other PMSs and mutual funds. And that in a way explains our superior returns as well. Because if you buy what the entire market is buying, you can't have a significantly different return profile. Your return will also end up being very similar to most other players that you are investing into otherwise. Long-term and low churn, of course, automatically adds up to compounding because if you are not churning, you're not really spending unnecessarily cost in terms of creation of the portfolio. Neither are you paying taxes. Now, in a portfolio which is seeing heavy churn on a yearly basis, typically investors end up paying close to about 25% in tax on the short-term gains. Whereas in our case, which is largely long-term capital gains, and that too, we end up paying once in maybe 5 to 7 years. Now, if one were to annualize this tax impact over the next 5 to 7 years, you are actually reducing the tax impact to barely about 1.5 to 2% on an annualized basis. Now, this difference of 25% against 2% on an annualized basis ends up having a huge impact on the long-term compounding. And that again shows up in our performance numbers when we report almost about 43% or a 5 year basis. When some of our stocks like Shakti's become close to about 40x and we are yet to pay a single rupee in tax. So that explains in terms of how the compounding impact happens. Navigating market volatility, I'm sure we've already had a lot of questions asking us in terms of, what our thoughts are in terms of the market and how to navigate the current market right now. So just trying to list down some of our thoughts in terms of how we are looking at this thing. So we believe this volatility will continue in the near term as we continue to grapple with the Trump tariffs and the geopolitical issues. How and when do this settle? It's anybody's guess. People are hoping that by November we should see some resolution of the tariff. If that announcement comes about, probably market may see a short-term exuberance again. From a long-term perspective, I think everybody is looking at what happens on the growth parameter. With this whole income tax reduction, which has got into from the current financial year, and the GST boost which has happened, everyone is hoping to see the consumption coming back. If the consumption starts showing its true colors, probably that should have a multiplier effect, and then probably market should start building upon that thing. If that were to happen, then probably in next 6 months' time, we should see the markets stabilizing. Markets are already in range bound, but probably the positive sentiments will start coming back into the markets. Current market, which is why it becomes very favorable for stock pickers, for the reasons which I mentioned, that if anybody is looking to build a business from a long-term perspective, I think you can't have a better situation than this, where the stocks have corrected and the businesses are showing growth. So anybody which is doing ground up investing and can look at buying into businesses which is delivering growth at a reasonable valuation, you can't lose money at that. Yes, we may go through our own bit of mark to markets in terms of short-term market volatility, but from a long-term perspective, you can't lose money buying in the current market environment. We are very comfortable with the current fundamental matrices that we have across our portfolio, and we are buying deep into the companies. And like I said, we are extremely happy to be in the current market situation, which is allowing us to build up on the portfolio as the weaker hands exit or they book profits coming back on the last 3 or 4 years of market run up that happened. Staggered buying approach, needless to say, even when we're saying that this is a stock pickers market and everything else, it would not make sense to go and put entire money upfront. We are not doing it ourselves. So while we are extremely conservative in our own minds and looking to build a portfolio with a reasonable caution, and that's how staggered buying has to be done. So this is an environment where probably one should look to leverage the volatility to their advantage and build up every time you get an opportunity. That's some interesting statistics to share. We are already in about 13 months of correction in the current market. It started from last September, or probably 12 months exactly. If I just look back last 15, 18 years and look at the time the correction has existed, the longest that it has taken has been in this period of about 1819, which was about 18 months correction. If you look at 2008-9, it was about 420 days, which is roughly about 15 months. So broadly, the correction has been in the range of about 15 to 18 months. We are close to about 10 months of 12 months of consolidation. Now, despite having gone through a GFC or a bear phase between 11 to 13 and India's own Black Swan event, which saw probably the longest tenure of correction in the market, we are already at about 12 months in correction. So if one were to look at history, and probably it's another 4 to 5 months before the market sees stability. And that, in a way, may end up coinciding with markets seeing the growth coming about on back of consumption or settling of some of these geopolitical issues. Either which ways happens, and the market probably may turn extremely positive from where we are. The only challenge is that nobody knows when does this period begin. And which is again why we believe that this is a fantastic time to build a portfolio and be invested, and so that you are there when the market turns. Small caps or micro caps being the way they are, they can probably rise very, very sharply and show you a good 30-40% upside in just a period of 3 to 4 months' time. So one needs to be invested into high quality stocks before the rally begins so that you can make the most of this rally. that's where I would like to end and probably leave the floor open now for any questions that you guys have. I think we already have a lot of questions come in the chat group. I'd request Sparsh to take it up.
All right. Thank you, Pawan. Thank you, Ssuneet. Very insightful. And I'd like to move forward to the questions. We have some very interesting questions here. Just to start things off, the first thing that I've heard from a lot of people that Equitree has already seen so many multi-baggers. We've already given it 10x in the last 5 years. What value add does a new investor joining us today get? Does it still make sense to buy the same old 15 stocks, or should we wait for a new fund?
Well, investing doesn't have to be done from an absolute return perspective, looking at the history. I think what is more important is what the future holds into some of these businesses. Like I mentioned, most of our businesses are looking very sweetly poised for delivering a good 20-25% compounding. And the valuations are close to their 10-year averages. In fact, let me quote something interesting over here, Sparsh, and probably that'll put this whole thing into perspective. If you look around the most wealthiest people in the world, these have all been people who have been entrepreneurs who are running their businesses for very, very long time. Of course, some of them have been from the IT side, and that's a completely different segment of business to be in. But it's been the entrepreneurs who have been running their businesses for longer periods of time. Now, if you come to think of it, as an entrepreneur, if somebody is running a business for good 20-25 years, and that catapults them into the largest wealth creators, the second best option that an investor has is then to just ride on to this kind of businesses and be a shareholder into this business, rather than trying to chase momentum every now and then from here to there, which, while it creates short-term cash flows, it will never yield long-term wealth creation. And that's how we look at our investing.
Great, thank you. I would just like to open this up for all our current attendees. You can post your questions in the Q&A option here so that we can review it and start answering. But I have another question in the pipeline. It talks about the new portfolio deployment strategy for investors. How do we look at position sizing in small micro caps? You mentioned that Equitree has a concentrated portfolio. Can we talk more about why we have a concentrated portfolio and what is the allocation limits we follow when it comes to individual stocks and sectors?
So there are three questions in that club together. One is on the position sizing. One is on how much are we deploying right now, or what is our deployment strategy? Let me answer one by one. So from a position sizing perspective, it's extremely important. I mean, this is a genre where you're looking at creating disproportionate wealth over a longer period of time. It doesn't help to have a small allocation into this genre of investing and then hope that you will keep building up on that thing. Unlike in a large cap investment strategy where one can do SIPs, because large cap stock prices don't move very sharply as against our genre of micro cap companies. Here you have to buy when there is an opportunity available in the market. And if you don't do a right position sizing, it doesn't add anything significant to the portfolio. When if you come to imagine about, deploying just a 3-4 lakh position into each stock, even if that stock were to become a 5x, it's not going to be reasonable enough for you to move the needle in terms of the financial wealth creation for the investor. And which is why the right position sizing is important. From our own deployment perspective, today, given that the market has been seen decent correction and the stocks are close to their 10-year averages, we're very comfortable deploying 60-65% upfront and holding about 30-35% in cash, which probably we will start deploying as we get opportunities in the market.
I have a question regarding the exit strategy Equitree follows. So naturally, when we find these companies very early on, they're at a 2,000 crore market cap, let's say. Once it becomes a multi-bag or something like a Shakti Pumps or an HBL Engineering or 10x, 20x, 30x, what kind of exit discipline do we follow? Or do we just continue holding the wave of growth?
No, so we are very, very disciplined with respect to our exits. As much as what we look at our valuation ratios when we are buying into the companies, equally we are disciplined to look at the PG as a exit barometer. So the minute we start seeing PEG crossing 2, which is price to earnings growth, and that practically means that now we are paying almost double in terms of valuation than what the business is growing. In that situation, we are happy to press the sell button and get out. In fact, that's where over the last 2 years, we've exited 5 of our portfolio companies that we were holding for the last about 5 years because the valuation went ahead of our comfort zone. And we have added another 5 companies in the portfolio.
Got it. Uh, I have a interesting question. The elephant in the room, right? Artificial intelligence. What is the impact of AI playing out in the, let's break it down into the Indian growth story and then to Equitree's portfolio. And how are we thinking about capturing some of these AI related growth opportunities going forward?
Well, AI definitely is changing the way things are being done. Uh, from our understanding and from our investment perspective, a lot of the service businesses are getting impacted because of AI. We are more focused on investing into hardcore manufacturing and engineering businesses or infra ancillaries. There, AI is not disrupting the businesses. One thing that we are very conscious about is the longevity of the businesses that we are investing into. It's extremely important to us to look at how far the business can survive. In fact, even when we are buying, we typically like to buy businesses which have been in existence for at least about 2 decades. And that itself talks about the longevity of the business. Because when you're talking of a 5, 7 year compounding, but if the business is not good enough to even survive for that long, it doesn't really make sense from an investing perspective. We generally don't like to buy into IT or ITES or new age tech businesses. One, because probably we are limited by our own domain expertise in this genre. We are not keeping up pace with the changing technologies. In all probabilities, we may end up buying into something which is already becoming redundant. So we rather focus on what we understand reasonably well and deep into. And so far as these businesses can equally compound at 25%, well, it's good that some AI businesses can also deliver significantly higher growth. But the way we look at it is that can I be into all parties in the town? And probably the answer is that I don't need to. So we're quite comfortable in our skim to be focused on investing into this genre and allow it to compound.
Sure, great, thank you. We've heard a lot about like success stories and like multi-bagger stocks, but can you throw some light on a stock that you got it wrong, where you had to exit at a loss, and how did that ideology and thinking process work?
Well, we've had our share of misses as well. If we didn't, then probably we're not trying enough. So that's part and parcel of the game. And we are quite conscious that yes, in the journey, we will get some investment calls wrong. And there are only one reason, one fundamental reason for us to get any investment call wrong, and that is the promoter himself. So either the promoter has not been able to execute the business, or we land up into some kind of a corporate governance issue. Despite all the effort that we put into the due diligence and everything else, but probably we still end up getting caught in some kind of a corporate governance issue. There's no other third reason because we don't take any business existence risk. And that's exactly been the experience. So we keep learning from the experiences and hope that we don't repeat the same mistake again. So for example, getting succession planning in place. And that's been one of the biggest learning to make sure that family run businesses don't land up into ownership issues, which can have an impact on the business. Corporate governance is something that probably flares up in the first year of our holding. It's very rare that you will end up seeing a promoter being greedy or the corporate governance getting hit in the fourth year of your holding. And which is why whenever we are onboarding a new business, we like to build our positions reasonably. So it's not that you go out and you buy 5% of a new business that you are looking to buy upfront. We could probably start with 0.5% or 1%, see how the journey goes with the promoter, and then look to scale up on the business.
So maybe can you take a name and talk about an example of a company where you got it wrong?
Well, I'll refrain from taking any names on this kind of an open platform, Sparsh.
Sure, no worries. I have a question regarding the overall market sentiment right now. While we got a understanding that there's a 3 to 6 month lag for a new investor coming in today, what kind of allocations are we doing? And will their portfolio construct look the same as an investor who came in, let's say, 1 year ago or 5 years ago? What kind of differentiation are we doing? Is it a model portfolio? How does it differ?
So it's a model portfolio in the sense that we are buying deep into the existing 15 companies. So the companies remain the same. The allocations differ at each investor level depending at the time at which the money is coming in. So for example, the money that we were getting in November, December last year, and the market had already started to see some correction, but our portfolio was seeing upward move. So we knew that it can't be a situation where the whole market is correcting and we are just going up. So we had to had our share of correction as well. So we had deployed only 30% of the portfolio back then, and we were sitting on 70% in cash, which we did see in the month of Feb, when we saw our share of correction happening. And that's where we started deploying the 70%. Like I mentioned earlier, in today's parlance, where the stocks have been corrected and they have been within the range for some time now, we're quite comfortable deploying 60-65% upfront and hold the balance where we can deploy over the next 3 months as the volatility plays out.
What kind of expectation should you set for an investor who is looking to talk to you now? Because if you look at the recency bias, last 5 years, we are outperforming top of the charts. For the next 3 to 5 years, what kind of expectation would you like to set?
Well, I would not expect anybody to hope that, you should be looking at a 45% compounded return. I mean, those are never sustainable returns. I think we would end up doing a good job if we are able to maintain a good long-term sustainable 25% compounding. And if you come to think of it, a 25% compounding over a 10-year period leads into almost about 10x on the portfolio. And like I mentioned earlier, large part of this compounding has to come with the underlying growth of the business itself. So we don't have to play the market to generate the returns. And that automatically sets the bare minimum benchmark in terms of return expectation.
Great. I think we've covered most questions. If anyone has any specific questions, please feel free to reach out to us. Happy to talk one-on-one. And one last thing, people have asked, why are we not looking at sunrise sectors like CDMO or healthcare? Do we have anything there?
Well, we are looking at CDMO. Again, the thing is that CDMO has become the buzzword at this point in time. Practically every pharma company worth its salt is claiming that they are doing CDMO. And that cannot be the case because it's a very complex segment to be in. So we are taking our time to understand some of these businesses in terms of how they are building up, what they are doing, and what the visibility is like. Again, that's a business which remains very erratic because from a CDMO perspective, if the patent holder takes longer to commercialize a particular product, that can completely impact your own business. So the business, I mean, that remains an option value when we are evaluating certain businesses. It's not that it's a discovered CDMO. If you're buying into a discovered CDMO, then there will be no valuation to really play out for. These are all discovered ideas. Stocks would have already run up. And buying into those will not create any substantial return from where we are right now. The valuations have already factored into some of these things. So we are evaluating this space, and if we find something reasonable and relevant, we'll be happy to buy into that.
Sure, great. And one last question now. With the GST cut, there has been a lot of focus on the consumption theme. So is there anything specific that we are looking at buying in the consumption space, maybe consumer durables? Can we throw some light there?
So we already have one company in that consumer, not say consumer durable, this is into more of kitchen appliances. So we are conscious of this thing. And in fact, not now, we started buying into this business almost about a year back now. We are looking at certain other consumer driven segments at this point in time, trying to look for differentiated business models which fit into our desired characteristics of companies that we look for. I think there's a huge amount of merit into looking into some of these businesses. Hopefully, we should be doing something very soon.
Great. And lastly, can we just throw a little bit of details regarding our gift city structure? Why are we setting it up? How would that work?
I'll ask Ssuneet to take this up.
Hi, thank you, Pawan. Thank you, Sparsh. So this gift city structure is basically for the foreign investors. The lot of NRIs who've been opening account in PMS facing a lot of problems with the documentation, and this will help them reduce those kind of documentation. Plus, there are a lot of trust and corporates who wants to participate in the Indian journey, and that's the best structure we have. So there are a couple of investors who have approached us, and for them we have opened this. So it should be ready in next 1 month's time.
For any specific details on the collaterals on this fund, reach out to us and I'll be happy to share them with you.
So that will
I'll
be
give
the
you
same strategy what we have for the Indian domestic PMS. We would be running the same strategy there as well. Same concentrated portfolio, value investing, and fundamentally strong businesses with a long-term horizon of 3 to 5 years. We would be targeting companies with a 25% CAGR growth and similar philosophy of Equitree's domestic PMS, which is working fine so far.
Great. I think I'll hand it off to you, Pawan and Suneet, for the closing statements. And thank you, everyone. You guys have been very attentive and a wonderful crowd. And thanks for attending.
Thanks, Persh. It's been a pleasure sharing our journey and our thought process in terms of how we look at the market and some of the nuances that we spoke about. Both Suneet and me are always available in case if anybody has any questions. I'm sure that there would probably be far many more questions that we may not have been able to address, but people can reach out to us directly or through Spursh. We'll be more than happy to take it up. And
Thank you
hopefully,
again. Thank you so much. Thank you all our investors, partners, stakeholders. Thank you again. We should be having this webinar more often. This was the first of its kind. Let's hope to come back in next quarter.
Great.
thank you. Thank you, guys.
Thank you.